So you've gone through, set up a captive insurance company, done a feasibility study, done an actuarial study, submitted all that stuff to the Department of Insurance, gotten approval for your captive, funded the initial capital and surplus, paid the premiums. Now what? In this video, I'm going to go through the proper ways and the different ways to govern a captive insurance company. As the IRS audits have pointed out, it's not how you set it up, but it's really how you run it that's most important. Hi, my name is Wes Sirk. I'm the president of Risk Management Advisors, a risk strategies company. And in this video, we're going to go through what are the different ways to govern a captive insurance company. In my book, Taken Captive, we talked a lot about the proper setup and governance of a captive insurance company. The purpose of governing the captive is to create a framework on how the captive insurance company writes the policies, pays the claims, what are the procedures that the board has to follow for the running of the captive insurance company. So to me, there's no one governance method that's any better than any other governance method. Now, we do have companies that have one main way to govern, but they pick and choose different aspects from other systems of governance that they want to add into their captive insurance company. When we go through these, it should be in the back of your mind that you should really be looking at it as, does one resonate with you more than the others? But if the others have areas that you like, then you can certainly add that on. So every captive is going to be different based on the policies and procedures, and you need to really figure out what's appropriate for your own captive insurance company. So the first way is the traditional model. Now, this is considered by many to be the oldest corporate model in use today. And there's records dating back to the 1700s on this way to govern a corporation. So the way that works is there's a corporate board. So take it a captive or any other business, you have a board. You also have a chairman of the board. So the board comes together collectively and has one voice that actually speaks for the board as a whole. So that board can delegate responsibilities to different committees underneath the board. So if you had a board of directors, you have committees. Maybe you have a policy committee. Maybe you have a claims committee. Maybe you have a, corporate governance committee. But what happens is all of these subcommittees come up and then they make their recommendation, and then it's the chairman or the CEO that takes the initiative and brings this forward. The second type of governance is what I call the policy model. So there's two main principles to the policy model. The first is the boards define the ends of the captive. So what does the captive want to accomplish? It's one of those begin with the ends in mind. The second principle is that the board then creates policies that will get them to the ends that they want. So if a captive wants to have a result, let's say your result is lowering your premium by a certain amount and to have a certain amount of capital and surplus at the end of the year that can then go back to the shareholders of the business. Then you begin with that goal, but then the policies and procedures that are put in place get you to lowering your premiums and getting you to that surplus amount that then gets returned back. So that could be the way you pay claims, that could be the way you set your premiums, a lot of stuff comes in. Under this policy model, the board's policies that are created, remember to get you to the end in mind, they create a series of limitations concerning what the CEO can do, cannot do, what is entitled to. So it gives the CEO, the chairman of the board, more latitude for deciding the means to get to the end. Because you're just defining, hey, this is what the end should be. And we have some general policies, but it gives the chairman more leeway to get to the ends that they actually want to get to. So the third type is the outcome model. As its name implies, the outcome model looks at defining the outcome that it wants for its shareholders, business, policyholders. So the board sets standards and expectations and performance results according to what the vision of the captive is, what the outcome that they want. So not surprisingly, clarifying and setting the outcomes to achieve success become the primary duty for the board. So it's useful, this model is useful in assessing the performance and success of the CEO and the board because they have a clearly defined outcome that they want and they're accountable to those outcomes. The next type of corporate governance is the competency model. And with all of this governance stuff, there are whole MBA courses that teach the ins and outs of all of these different models. So, we're kind of giving it short shrift by just spending 2 to 3 minutes on each one. But the competency model is best suited for boards, for captive boards that intend on developing the knowledge and skills of the director. So it wants to foster communication, relationships, and achieve a higher level of performance for the board. In the competency model, one drawback I would say is it does not tell the board how to set policies and strategy and monitor all the functions of the board. It just tries to get them to work better together. We don't use that a lot in our practice, which leads me to the final way to do governance. And this model, I would say by far, is the most often used in our practice, and that is the consensus model. So as the name implies, just like the other ones, the consensus model, it assumes that all board members are equal and therefore equitably share responsibilities and come to a consensus. So the model of corporate governance is focused on how decision-making is achieved by the board. So this works really well when you have, boards of 5 people or less, because they can come together. The board, the corporate governance, tells them how they make a decision. Now, one very strong key to this is the use of Robert's Rules of Order. So you have a motion, you have a second, all in favor, aye, all opposed, no. And then all of those minutes get recorded. So we have a history of all of the things discussed, when dividends were requested, why they were requested, what they want to do, any new policies are going to be issued, claims issued. So all of it gets recorded, and we have a very clear roadmap of from when we started it, what the objectives were, and then if any of the objectives changed throughout the years, and then so any of the captive owners, or if the business has changed from one generation to the next, or they sell to another buyer, well, now there's a history of everything that went on with this captive insurance company. So bringing it all back together, there were the 5 types of corporate governance that we discussed were the traditional, and this was the one that goes back, to the 1700s. There was the policy model, where the board defines the end results of the captive and sets policies to get them to that end. There's the outcome model, which, as it defines the outcome of the members or the policyholders that the boards then have to act towards. Competency model, developing the skill and knowledge of all the individual board members and captive directors, and then the consensus. And the consensus, is the one most used in our practice, where all board members are equal and they all get a vote, and you need a consensus to move forward. Thanks for watching this video. Once again, my name's Wes Sirk, and I'm the president of Risk Management Advisors, and we've just redone our ultimate guide to captive insurance companies. So if you'd like a copy of it, just go down below in the comments section and put, I'd like a copy, or send it to me or something, and then I or someone from my team, because we go through all of these comments, questions, suggestions, just put it down there and we will make sure that we get it sent to you. Thanks so much for watching. Have a great day. Bye-bye.